Wait, I have to wait till after we get the
Greetings.
webcast. Yeah.
Greetings and welcome to the
There we go.
AMC Entertainment Holdings, Inc. First Quarter 2024 Earnings Webcast. At this time, all participants are in a listen-only mode. A question-and-answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star zero on your telephone keypad. As a reminder, this conference is being recorded. I would now like to turn the conference over to your host, John Merriweather, Vice President, Capital Markets and IR. Please go ahead, sir.
Thank you, Joe. Good afternoon. I'd like to welcome everyone to AMC's First Quarter 2024 Earnings Webcast. With me this afternoon is Adam Aron, our Chairman and CEO, and Sean Goodman, our Chief Financial Officer. Before I turn the webcast over to Adam, let me remind everyone that some of the comments made by management during this webcast may contain forward-looking statements that are based on management's current expectations. Numerous risks, uncertainties, and other factors may cause actual results to differ materially from those that might be expressed today. Many of these risks and uncertainties are discussed in our most recent public filings, including our most recently filed 10-Q and 10-K. Several of the factors that will determine the company's future results are beyond the ability of the company to control or predict. In light of the uncertainties inherent in any forward-looking statements, listeners are cautioned against relying on these statements. The company undertakes no obligation to revise or update any forward-looking statements, whether as a result of new information or future events. On this webcast, we may reference non-GAAP financial measures, such as adjusted EBITDA, constant currency, free cash flow, among others. For a full reconciliation of our non-GAAP measures to GAAP results, please see our earnings release posted in the Investor Relations section of our website earlier this afternoon. After our prepared remarks, there will be a question-and-answer session. This afternoon's webcast is being recorded, and a replay will be available in the Investor Relations section of our website at amctheaters.com later today. With that, I'll turn the call over to Adam.
There we go.
Thank you, John.
So
Good
we're back.
afternoon, one and all, and thank you for joining us today. Against the backdrop of an industry box office that was hampered by Hollywood's strike-induced production delays, AMC once again outperformed. We exceeded Wall Street expectations for total revenues, adjusted EBITDA, net income, and diluted earnings per share.
That's how we do, ladies and
It was
gentlemen.
no surprise to most astute observers that the number of major film releases in the first quarter of 2024 would be greatly reduced because of production delays caused by the 5-month-long actors and writers strikes of 2023 in Hollywood. Indeed, we saw that one major studio had its first quarter domestic box office revenues decrease by an astounding 98% compared to the first quarter of 2023. That studio's decline was not because of some strategic shift to streaming or a disinterest by consumers in going to movie theaters. It was solely because they were not able to release new films into the market due to the actors and writers strikes of midsummer last year. However, at AMC, we were heartened by several important events in the first quarter. First, that moviegoing bounced back in March, which was a considerably stronger month than January or February. Second, that our company's intensive review of the movies coming out later in 2024, 2025, and 2026 suggests, in our view, that very good times are ahead for the movie theater industry. And third, that our company, AMC Entertainment, performed so well in Q1, increasing our market share and continuing to become a more potent and more efficient operator. Notwithstanding a 6% decline in the quarter's North American box office compared to 2023, AMC's total revenue remained broadly in line with the prior year, and our per-patron revenue and per-patron profit continued along their stellar growth trajectory, with all-time first-quarter records achieved on these two metrics in our domestic business. At AMC in the quarter, our total revenue per patron was almost 36% above the pre-pandemic level in Q1 of 2019.
That's huge.
And even more impressive
That's massive.
is that our contribution margin per patron, defined as total revenue, less film exhibition costs, and less food and beverage costs, divided by the number of patrons, was almost 44% above pre-pandemic Q1 of 2019. These achievements are thanks to our relentless focus on enhancing the guest experience at our theaters, while at the same time driving efficiency in our operations. Through our resilience, resolve, creativity, and flexibility, AMC continues to adeptly navigate through changing and challenging circumstances. Our surging revenues per patron and surging profit per patron numbers are why at AMC we believe that there is now a path for AMC to achieve the same levels of EBITDA that we enjoyed pre-pandemic, even at lower levels of revenue. What's more, if and when the industry revenue does fully recover, we would then expect to be able to achieve substantially higher levels of EBITDA than we did in the past. Moviegoer sentiment is clear. Guests want to see movies on a huge silver screen, and they are consistently willing to pay more for the best possible experience. That certainly favors AMC, as we have more premium large format screens, namely IMAX, Dolby Cinema, and Prime, than any other cinema operator in the world. Consumers are also paying up for innovative food and beverage offerings, and AMC continues to outsell all our major competitors in F&B. All moviegoers also are now buying movie-themed merchandise from us online and at our concession stands in quantities that we have never before seen. Enough said from me about the first quarter of 2024, because my focus is not on a strike that impacted January and February movie releases. It is instead on two other things. First, is not the movies that were not released in January and February. It is instead the movie slate that is coming over the next 2 years to 2.5 years. I am more optimistic now about the future of movie theaters than I have ever been. And that's because of the movie slate that's coming, especially towards the end of 2024, in 2025, and again in the first half of 26, which hold, in my opinion, great promise. Second, I'm paying great attention to our cash reserves. I've said over and over again on these calls and webcasts that cash is king, and that the smartest thing AMC has ever done since COVID hit in 2020 was to make sure that our cash reserves at AMC were robust, while other theater operators fell by the wayside. To that end, it is so energizing and so reassuring that we had $624 million of unrestricted cash at the end of Q1, and that AMC has raised yet another $124.1 million of equity capital since March 31. With cash in the bank,
Share offering
we
is
are
over.
better prepared
They did
to
it.
weather any storm. But fortunately, storms do end. As a result, we see the box office turning an important corner later this year and again in full year 2025. This is not just AMC's view. Having recently returned from our industry's largest and most important annual gathering, CinemaCon, the positive energy in the air was palpable. One studio after another confirmed that film production was once again in full motion, that they were eager to bring more titles to the silver screen, and that the value of theatrical exhibition has never been more evident. I'm not going to regale you on this webcast with all the titles of the cavalcade of big movies that are coming, but they are indeed coming. And it all starts in just a few months with a great slate of movies exclusively for theatrical exhibition. They include new characters and captivating storylines, along with familiar faces and popular franchises. When I look at year-end 2024, and especially at full year 2025, and I see an industry box office, I don't think I should say yet, hallelujah, let the good times roll. But I can finally say with confidence, hallelujah, let the significantly better times roll.
I'll take it.
Things are looking up as we look ahead. I'll now pass this webcast over to Sean to provide more details on our financial results just released, after which I'll return to update you on some key initiatives before taking questions from our sell-side analysts and from our retail shareholders.
All looks good to me. All looks good to me.
Thanks, Adam, and thank you to everyone for joining us this afternoon. The box office in the first quarter was impacted by last year's Hollywood strikes. Despite a 6% decline in the North American box office compared to Q1 of 2023, AMC was able to maintain total revenue within 1% of last year's first quarter. This was achieved thanks to the North American market share growing by over 70 basis points, more than any other top 50 theater operator, solid attendance growth in our European business of approximately 6%, and total revenue per patron growth of 1.8%.
That's great
Now,
news.
looking at our domestic segment and comparing the first quarter of 2024 to Q1 of 2023, with the box office down by approximately 6%, our admissions revenue declined by 3.2%, outperforming the industry, and total revenue declined by only 2.2%. Total revenue per patron increased by 3.8%, with admissions revenue per patron up by 2.7% and food and beverage revenue per patron up by 1.2%. These per patron metrics were all-time first quarter records for AMC, and our total revenue per patron was some 43% ahead of the first quarter of pre-pandemic 2019. In addition, our contribution margin per patron, which we define as total revenue less film exhibition costs and less food and beverage costs, divided by the number of guests, was $15.32. This is 5% above the first quarter of 2023 and 54% above the first quarter of pre-pandemic 2019. These strong per patron metrics are as a result of the continued success of our innovative market-leading food and beverage offerings, as well as our alternative content and immersive PLF offerings, and revenue diversification initiatives such as retail popcorn. Add to this our ongoing theater portfolio rationalization and thoughtful expense management, and we end up with record-setting results. Now looking at our international segment and comparing the first quarter of 2024 to Q1 of 2023, this is all in constant currency. Admissions revenue increased by 3.7%, and total revenue increased by 2.8%. Total revenue per patron declined by 2.9%, with admissions revenue per patron down by 2% and food and beverage revenue per patron down by 1.4%. Note that total revenue per patron was 27.8% ahead of the first quarter of pre-pandemic 2019. Contribution margin per patron was 3.6% below the first quarter of 2023, up 30.3% above the first quarter of pre-pandemic 2019. Our international per patron metrics this quarter were adversely impacted by country mix, with relatively strong attendance growth in the traditionally lower revenue per patron market of Italy, coupled with attendance declines in the traditionally higher revenue per patron markets of Sweden and Germany. In addition, while our European attendance benefited from strong local content offerings, particularly in Finland, Germany, Italy, and Sweden, such content is associated with lower PLF mix and lower revenue per patron. As we continue along our recovery glide path, we will maintain our focus on providing a differentiated, high-value guest experience at our theaters across the globe and profitable revenue growth through diversification initiatives such as retail popcorn, AMC-branded candy, and the distribution of alternative content. All of this while paying very close attention to our overall operating efficiency. Now moving to cash flow and the balance sheet. We ended the first quarter of 2024 with unrestricted cash of $624.2 million, which translates into $188.3 million of net cash used in operating activities for the quarter.
It's pretty huge.
This is broadly in line with the net cash used in operating activities in Q1 of 2023. CapEx, net of landlord contributions, was $46 million in the first quarter. We continue to expect net CapEx in 2024 to be in the range of $175 to $225 million. From a theater portfolio perspective, we continue to actively manage our footprint. During the first quarter, we closed 4 underperforming locations and we added 1 new high-performing theater. This will bring the total number of locations closed since the pandemic began to 169 and the total number of new locations opened to 60 for a net reduction of 109 locations or 10.9% of our locations at December 31st, 2019. And we continue to see that the 60 new locations clearly outperform the 169 closed locations. To ensure our ongoing recovery and position us to thrive as our industry grows, our top 2 capital allocation priorities must remain. Number 1, we must ensure that we have sufficient liquidity to manage through our recovery phase, including the impact of last year's Hollywood strikes. And number 2, we must strengthen our balance sheet by extending debt maturities and improving our financial leverage. During the first quarter, we exchanged $17.5 million of debt for roughly 2.5 million shares of common stock, recording a profit of $5.8 million. And we also repaid approximately $8.4 million of deferred rent. The deferred rent balance at the end of Q1 was $47.9 million, and we would plan to reduce this balance by another approximately $12 million by the end of 2024. Thus far, during the second quarter of 2024, we have raised $124.1 million of gross equity proceeds, excluding commissions and fees, through the sale of approximately 38.5 million shares under our existing ATM or at-the-market offering program. So overall, since the beginning of 2022, so over the last 2.3 years, we have raised nearly $1.2 billion of gross equity capital. We've lowered the principal value of our debt and finance leases by $707 million through debt repayments, repurchases, or exchanges of debt for equity, and we've repaid $267 million of deferred leases. This all for a total reduction of debt and deferred leases of $974 million. This debt reduction has also lowered our annual cash interest expense by approximately $60 million. These actions have prepared us to face with confidence a relatively weak box office in the first half of 2024. And while the second quarter is forecast to be well below 2023's record second quarter, that quarter benefited from the tremendous success of titles such as Super Mario Brothers, Guardians of the Galaxy, and Spider-Man Across the Spider-Verse. We are increasingly enthusiastic about the second half of the year and a return to a strong and vibrant post-pandemic growth trajectory. And now I'll hand the webcast back over to Adam.
Thank you, Sean. Before taking your questions, I'd like to bring you all up to date on 5 ongoing initiatives at AMC.
Here we go. Let's hear it.
First is our continuing dialogue with several of the world's greatest musical artists. As you know, for the first time in our company's history, in late 2023, we surprised the world with our Taylor Swift and Beyoncé concert films. That appears to be the gift that keeps on giving, because ever since, we've been in conversation with artist after artist after artist after artist, some of the biggest names who routinely fill arenas and stadiums the world over. That has led to an announcement just yesterday of our collaboration with 9-time Grammy winner and 2-time Academy Award winner Billie Eilish, in partnership with Apple Music and Interscope Records. Next week, on May 16 and 17, our AMC Theater Dolby Cinemas will be an integral part of the launch of her new album, Hit Me Hard and Soft. In a special listening event, Billie Eilish fans will be able to hear the new album in Dolby Atmos sound exclusively at AMC Theaters the day before the album is released to the public.
Another one.
The visual content on screen has been carefully selected to delight those in attendance. This is just the beginning of the innovative programming that will be coming to our theaters from our new distribution arm, AMC Theaters Distribution. While the Billie Eilish listening event will take place only at AMC locations, we took great pride that so many of our fellow movie theater operators were included in our efforts with Taylor Swift and Beyoncé. We expect going forward that some of our activity in this sphere will be exclusively held at AMC locations only, and that other activity cooperatively will be shared across our entire industry. Second, let's talk briefly about the success of AMC's Retail Popcorn Initiative, which just now has celebrated its 1-year anniversary. Initially offered exclusively at Walmart, with ready-to-eat popcorn at just 550 locations, but within weeks thereafter, we introduced our microwave popcorn varieties, and we expanded to some 2,600 Walmart stores, as well as to Walmart.com. Sales have been brisk, and more retailers have decided to carry our branded popcorn for the home. Today, AMC's Perfectly Popcorn is now sold at 6,500 points of distribution, or nearly 12 times as many locations as when we first launched a year ago. We've added Amazon.com as well, and grocery juggernauts Publix and Kroger to our distribution channels, and we are ambitiously pursuing further growth, adding more grocery chains as we look ahead later this year and next. The third topic to discuss today is our exploding food and beverage sales numbers, which lead the industry among major operators in the United States. Naturally, we're pleased that the New York State Legislature just weeks ago agreed to allow movie theaters to serve alcohol, a ban that has been in place for almost a century, believe it or not. This means for us that we can have lucrative liquor sales at 30 more AMC movie theaters across the state of New York. Beyond that, our culinary team continues to work passionately on innovative in-theater food and beverage offerings. For example, at more than 400 AMC theaters across the country in the United States, we've just added new, fresh donut hole offerings in multiple flavors to sweeten the movie-going experience. The Baker's Dozen shareable donut holes come in 3 heavenly flavors: cinnamon sugar, strawberry, and our proprietary peanut butter blend created in partnership with PB2. Every serving comes with a container of warm icing to make each bite even sweeter and to add just a few calories to this neat little offering at AMC.
That's fantastic.
These things might look like donut holes to our guests, but to us, they look like incremental dollars. We expect to sell a lot.
Cash is king, ladies and gentlemen.
Similarly, we're innovating at our 50 dine-in theaters as well, where guests are served a more comprehensive food and beverage menu. We've added 4 entirely new offerings: new artisan pizzas with 5 different toppings, 2 new chicken sandwich choices, each nestled on a toasted brioche bun, a new Caesar salad with chicken to complement our already popular Cobb salad, and last but certainly not least, again, to satisfy those sweet tooth or teeth, we've introduced milkshakes in 5 flavors, including chocolate with Ghirardelli chocolate syrup, vanilla, strawberry, peanut butter with a Reese's peanut butter sauce, and an Oreo shake with Oreo cookie pieces mixed in. It's no accident that AMC Food and Beverage leads the way in our industry. We devote substantial resources to imaginatively understanding the flavor palette and the diverse tastes and appetites of AMC moviegoers. The 4th topic to discuss quickly, at our European theaters, we have just introduced an intriguing innovation which we've named XL. We have branded more than 60 of our larger screen auditoriums, but screens that would not necessarily qualify as a premium large format. We've given them an XL name, XL for extra large, of course, and gently nudge into the market a small premium price in these auditoriums. We're watching the success of this new product very closely to see if we should expand the concept further in Europe and or to our U.S. theaters as well. And finally, 5th, we are taking our AMC Investor Connect program very seriously, both to reward our shareholders and to stimulate added patronage at our theaters from the more than 1 million members in this program. In the summer of 2021, AMC launched AMC Investor Connect, a first of its kind program in which our shareholders were invited to enroll so that we could engage directly with them. Investor benefits to our retail shareholders through AMC Investor Connect have included shareholder-exclusive promotions, NFTs, free or discounted items, invitation to special screenings, and communications directly from me as CEO of the business. Our continued commitment to AMC Investor Connect recognizes the important role that our retail shareholders have played in getting AMC through these past difficult COVID and strike-impacted years, and the program is designed to provide them with truly exclusive rewards and benefits. Especially knowing that there are many retail shareholders listening to this webcast right now, can I remind you all that at 7 p.m. local time tonight, in our IMAX, Dolby Cinema, and AMC Prime auditoriums, we are offering a special advanced screening of Disney's stunning new movie, that's right, Kingdom of the Planet of the Apes, which opens to the general public this weekend. We hope you enjoy it.
Special screening of Kingdom of the Planet of the Apes, donuts, food, and alcohol coming around nationwide and to the previously dry counties
now
in New York.
Time
Holy
to
cow.
take your questions. But before I do, here are our final thoughts on the first quarter and our near and longer term prospects. In the first quarter, AMC exceeded all expectations, a quarter that admittedly was impacted by last year's Hollywood strikes. The second quarter's box office, while likely will be sequentially stronger and bigger than Q1, but it will still, too, be impacted by the strikes of last year and will fall significantly below last year's second quarter because last year's second quarter just happened to be the single strongest quarter in all of 2023. However,
It was awesome. Still going to
when
be
we
strong.
speak again in August, after the second quarter is in the books, based on what we know today, we believe that the summer box office will be strong, healthy, and growing. AMC is poised handsomely to benefit as our movie-going audience will be thoroughly entertained next summer by titles playing at an AMC theater near you, including Disney's Deadpool and Wolverine and Universal's Despicable Me 4 and Twisters. And looking beyond just the summer, we similarly are excited about what we anticipate for the fourth quarter, with such blockbusters titles as Warner Brothers' Joker, Folie à Deux, Universal's Wicked, bringing to the screen the Broadway musical that has run for decades, and more, like Disney's Mufasa the Lion King and Sony's Venom, The Last Dance. I could go on and on and on about the movies that are coming in 2024.
It's going to be a banger.
But not only are we confident about the second half of 2024, we are also literally enthralled about an accelerating box office recovery as we head into 2025 and on into 2026. The box office in 2025 should be materially stronger than it has been in several years. AMC continues to be resilient, leveraging innovation as well as hard and smart work to navigate through these turbulent times. We have positioned ourselves not only to survive in troubled waters, but also to thrive as our industry grows. And as we look at 2025, we believe that our industry will again grow. We think the future, therefore, looks very bright. With that, Sean, let's move to questions.
Let's go. That's a lot of great news. A lot of great news. They closed down 100 theaters, 167, and opened up 60, outperformed.
Please press star 1 on your telephone keypad, and a confirmation tone will indicate your line is in the question queue.
Higher earnings per
if you would like to
patron.
remove your question from the queue. For
Higher
participants using
earnings
speaker
despite
equipment,
lower revenue.
It may be necessary to pick up your handset before pressing the star keys.
Diversified into
And our
thousands of
first question
stores,
comes from the
including
line of
Amazon.
Jim Goss with Barrington Research. Please proceed.
All right, thanks. Adam, regarding your discussion about food and beverage initiatives, clearly dollars are more important than margin percentages, but I wonder if you could talk about how you think in terms of introducing items and the pricing attached to those items, and where you feel the food and beverage margin should settle in. It's slipped a little bit in the last quarters for some of the reasons that have taken place.
So, Jim, we're picking up increased food and beverage sales, sort of staggering numbers. You know, pre-pandemic, routinely, food and beverage sales per patron were about $5 ahead at AMC. I'm using the domestic numbers as a placeholder, not the European numbers. The European numbers are a little bit less than the U.S. numbers. And they've shot up to around $8 to $9 ahead post-pandemic. So we're looking at a huge increase. And our F&B margins are in the low 80s. It varies item by item and quarter by quarter, but my rule of thumb is about 82% of incremental food and beverage sales flows to the bottom line. So when we pop a $4 increase in food and beverage spending over where we were a few years ago, like that's a huge driver of income for us. And it's one of the reasons that our revenue per patron is up so much. It's one of the reasons our profit per patron numbers are up so much. And it really comes from three factors, or maybe I should say four factors. One, we have slightly, and only slightly, raised the prices on our F&B products. Second, though, more and more people are stopping at our concession stands and buying food and beverage items from us. There is no rule that says you have to buy food or drink when you come into the movie theater. You can just buy the ticket, go to your chair, enjoy the movie, and leave. But what we have seen over the last couple of years is that we're doing a much better job in capturing more people to stop the concession stand and buy. The third factor is they're buying more items. So where someone used to buy one item, maybe they're buying two. If they're buying a drink and a popcorn, maybe they're buying a third item as well. If they're buying three items before, now they're stocking up and buying four. If there are multiple people in the party, maybe more people in the party.
Dilution has already been completed. The AMC share issuance is done, for those of you that are unaware. Adam Aaron's talking about theoreticals right now, so I just figured I'd let you guys know. I'm seeing some comments over here that are uninformed, and the fact of the matter is that AMC has already raised over $125 million from their most recent share issuance, which was completed today. So there is no more dilution coming. They have over $500 million in cash on hand, $624.2 million in cash and cash equivalents on hand right now, and they will not be issuing any more shares.
We had $54 million in merchandise sales just at our U.S. theaters. So that might affect the margins a little bit. But as I said, this whole area has been one of staggering success for us. We've given our food and beverage organization more staffing, more resources to run our F&B business. We've asked of them to launch innovative new products in our theaters, at our our theaters, at our concession stands, at our regular theaters, and so far so good. We're quite optimistic that this growth will continue, and that the margins are going to stay real high. I have often said you can do very well when you're selling air and water, air being popcorn and water being Coca-Cola. The whole industry has been pretty successful in improving its F&B numbers over the last few years, but AMC has really led the way. We've outpaced everybody else.
Okay, thanks. And just one other one. If we use the Billie Eilish concert or a pre-recorded concert as an example, is this something you think you could then share with cinema competitors, or is that just a one and done sort of thing? Or could you do a limited run at AMC, like every Wednesday or something of that nature, to take advantage of it, but not interfere with your first run theater or first run films?
So when you talk about every Wednesday, that means 52 Wednesdays.
Well, or not necessarily, just some pattern.
No, I know, but what I was going to say, with 9 Grammys and 2 Oscars, there aren't 52 Billie Eilishes. So I don't, and it's a tremendous amount of work to get these artists to agree to showcase their talent in our theaters. But that having been said, I don't think we'll be doing 52 a year of them. But I do think that we'll be doing several per year. Even a one-time listening event is lucrative for us on a per-screen basis. And, of course, the Taylor Swift and Beyonce concert films were enormous for AMC. They represented more than 15% of our total profitability for the year last year, if you look at the EBITDA they generated.
2 films.
I do think that many of the, I do think that I know from having talked to so many.
I'm going to pause him there for 10 seconds while he answers this kind of lame question and explain that in the last quarter of last year, AMC released only 2 films for distribution in 2023. Those 2 films are the Taylor Swift concert and the Beyonce concert. And with those 2 films, they became the number 9 top grossing distributor company in all of 2023. That was in the final quarter of the year. It was only 2 films. It was 15% of all of their net profits for the year. And that was a 2023 gross of over $213 million, selling nearly 20 million tickets off of those 2 concerts alone. And this year already, we've already got Billie Eilish, and who knows how many more. So with another 2 or 3 or 4, we could easily crack the top 8, the top 7, the top 6, or more, especially considering Angel Studios 20th Century will have weaker outlook this year because of the reduction in films being released due to the writer strikes. Thankfully, when it comes to films like these concerts, we don't need an entire plethora of writers and actors. So if they're on strike, they can still be filmed with a small crew and edited to release something amazing for moviegoers and fans.
To offer experiences not only at AMC, but also to take them to our competitors' theaters as well. So I really think it's an industry-wide opportunity, but AMC is blazing a new trail, and we're way out in front. And the summary is some of it we'll wind up doing ourselves alone, exclusively, and others we will certainly take to our competitors. I have to say, this is one circumstance where our competitors have been fabulous to work with. You know, we fight like cats and dogs all year long, but on pulling off Taylor Swift and pulling off Beyonce, so many of the names that you would recognize as major theater chains in the U.S., in Canada, in Mexico, in Europe, and globally, were our best possible partners in this effort, and we would expect to be able to bring more such experiences to them either later in 2024 or in 2025.
All right. Well, thanks very much for taking my questions.
Thank you, Jim.
And the next question comes from the line of Alicia Reese with Wedbush Securities. Please proceed.
It's the Wedbush shills.
I'm
Wedbush shills in the house.
The dynamics around market share in film rent, and so I'm just looking at, there are a few titles in the quarter that drove most of the box office, particularly domestically, and a lot of that coming from Dune, which presumably led your market share gains in the quarter, as you have the largest footprint of IMAX screens, and that played very well in IMAX. But I'm wondering if you could talk, at least qualitatively, about the dynamics that drove your film rent substantially lower year over year.
Sure. Sean, I'll throw in something, and Sean will take it in addition. If you look at the first quarter, there were fewer big blockbuster films and more middle-sized films that were in our theaters that did really well. And if you look at we've never really disclosed our deals studio by studio, but they tend to be on sliding scales where studios command a higher film rent on higher grossing films. And the fact that there were so many middle-sized and smaller films that led the way in the first quarter, that explains a lot of why the film rent reduction was achieved by AMC. Right? Anything?
Yeah, sure. I'll just give you a little bit more color. So when we look at the number of titles that we played in Q1 2024, over $5 million, we had 41 in Q1 versus 35 in Q1 2023. And obviously the box office was lower in 24 than 2023. So yes, June was the biggest title of the quarter, most significant. But after June, the box office per title went down quite significantly. And so it's exactly as Adam says, when the films have a lower gross per showing, that certainly impacts our film rent favorably.
Thank you.
Thank you. There are no further questions on the audio line. I would like to turn the call back to management for retail shareholders.
That was from Wedbush Securities, of course. The shows were in there, shows that have been constantly fined by FINRA time and time again, in order to try to come up with a way to make the stock look negative by pointing to certain films being what propped up AMC's revenue and profits last year.
While at the same
However,
time,
no worries, ladies and gentlemen.
Performing theaters. So can you comment about what we can attribute this success to? And do we see this market share growth as sustainable as the industry recovers?
Sure. So, yeah, it's a pretty impressive trick to increase your market share when you're closing 100 theaters. But that's exactly what we did. And part of it is, and as you mentioned in your earlier remarks, our 70 basis point improvement in market share with a higher market share growth than was achieved by any of the 50 largest movie theater circuits in the United States. That's very encouraging for us. Part of it is because we think our theaters are in good shape. Part of it is because we think we've got very strong marketing, which I'll talk about later. But also, what's really interesting is that the theaters that we are closing were our older, more tired theaters, buildings that were sort of at the end of their 20 or 30-year useful lives that weren't grossing all that much. And the theaters that we opened were shiny new ones in great locations, usually open with reclining seats to start. And as it turns out, it's incredible but true, the 60 theaters that we opened outgrossed the 169 theaters that we closed. So we're replacing older, tired, unsuccessful theaters with thriving ones. And some of the ones that we've opened are amongst literally our highest grossing, most profitable theaters in all of Europe and in all of the United States.
Terrific. And the next question is about AMC Cinema Suites. Question here is looking for an update on Cinema Suites, and is there a chance that we release these products on the retail channel?
So Cinema Suites is doing great. We're very pleased. As you all know, I think it was in the fourth quarter of 2023, we unveiled a proprietary house brand of premium gourmet candies, chocolate-covered peanuts, chocolate-covered raisins, chocolate-covered almonds, chocolate-covered pretzels. Four different SKUs. We say they're premium gourmet candies because they have a lot more chocolate. And we tend to charge the same price for Cinema Suites as we charge what I might call regular branded candies that everybody knows and loves. They've been selling well. We've been they're nicely ahead of expectations. We've had no problem with the supply chain and getting these delivered to us in quantity. And I would think that we would, in fact, take them to the retail market at some point going forward. Exactly when, I don't know.
Yes.
It's not the highest priority. There are other things that are higher on the list of things to do to make more money for AMC. But Cinema Suites have done great. We're glad we did it.
Great. And then the next question is about our capital expenditure. Can we provide some color on AMC's CapEx spend? Where are we allocating the money?
Well, since your nickname around here is Dr. No, and you're the one who rations capital, and we've done everything in our power not to spend capital expenditures at the moment, because our preference has been to build up our cash reserves for a rainy day. Why don't you answer the CapEx question?
Thanks, Adam. Well, it's true we are very disciplined in our capital spend, particularly during this recovery period. But the good news is that AMC has a very large number of high return investment opportunities. Right now, we're prioritizing those investments that maintain our existing buildings, our existing equipment, our IT capabilities, so that we can continue to provide the best possible guest experience. But we're always allocating our capital to the best risk-adjusted return opportunities, and we'll continue to do that. When I look to the future and I see sort of the pipeline of attractive investment opportunities we have, they include our premium large format auditoriums, sight and sound upgrades, automation of the guest experience, theater seating, etc. So again, there are many very attractive opportunities, but now around 75% of our capital spend is really focused on maintaining the assets to continue to provide the best possible guest experience.
Thank you, Sean. And I might add that I think the priority of spending has been maintenance CapEx first, because we have to keep our theaters in decent shape. But to the extent that we have additional monies in the door, our priority has been to use that to build up our cash reserves. My comments in my earlier prepared remarks that cash is king, it's a serious comment. I do believe that one of the reasons why AMC has defied gravity the last 4 years and surprised a lot of people who thought we might run into trouble that we didn't, is we built up our cash reserves intelligently. But having said that, there are so many interesting ways that we could reinvest in the business. And I personally think the most lucrative of those ideas is, as you said, the increased premium large format screens. I hope that we can add more IMAX screens and Dolby Cinema screens. We are the largest IMAX exhibitor in the world outside of China. We're the largest Dolby Cinema exhibitor in the world. We have about half of the IMAX locations in North America. We have all the Dolby Cinema locations in North America. Those auditoriums do extremely well. And if we can rustle up some capital expenditure money to do it, adding more of them is a great idea.
Agreed. Next question here is related to debt. The investor asks, with a significant amount of debt maturing in 2026, 2 years from now, what is the company doing to address this debt that is maturing and reduce the overall debt level?
So in terms of reducing the debt level,
let's see. Here we
we
go.
have done, I think, a phenomenal job
Debt reduction
over the
here.
last few years of paying down debt and other deferred obligations like deferred rent. In the last 2 years, roughly, we've paid off almost $1 billion of long-term debt and other deferred obligations, which is encouraging. We've done that in part by buying a lot of debt back in the open market at a discount, which means you're doing it at a profit, which is also good. Still realizing we are playing a capital allocation game of reducing debt, buying in debt, versus investing in the business through CapEx versus building up our cash reserves. It's a bit of an art form, which actually, Sean, you manage this process day to day. And we've paid off or reduced so much of our debt and obligations. It is kind of staggering to me that we had to borrow about $2 billion to survive COVID. And yet, if you look today at our net debt, AMC's net debt today is less than it was just prior to COVID. So how is it possible that, we had to borrow $2 billion to survive, and yet we have less debt today than we had going into COVID? And the answer, of course, is because we raised a lot of equity and we paid down debt, which is important for us to do. Looking
AMC
forward,
has paid down a ridiculous
we still
amount
have
of debt.
about $4.5 billion of debt.
No big deal.
Not
for a
much
multi-billion-dollar
matures
company.
before 2026, but there are huge maturities in 2026. And I can assure everyone listening to this call today that the management of this company, which has been pretty smart in how we've navigated ourselves through the pandemic heretofore, and a leveraged balance sheet without a lot of EBITDA heretofore, that same management team is wholly focused on the debt maturities that are due in 2026. This is not something that we're going to look at next year or the year after that. We've been working with our board of directors and our investment banks for almost a year now in discussing the smartest ways to extend the maturities of our 2026 debt into future time periods. The good news is that we have lender syndicates who generally like AMC, have worked with us before, are working with us now. I'm hopeful that we will come to some conclusion that will allow us to push out the debt maturities from 2026 into future periods. There's nothing to announce yet because there's nothing that's final or done yet. There's no agreement that's imminent, like it's going to be announced in a day or a week. But it has our highest attention. We know about our obligations coming forward. We intend to refinance if at all possible, and we're hopeful that we can do so on attractive terms.
There you have it, ladies and gentlemen. Adam Aaron and the
Absolutely agreed.
board of directors are
and then
working
the last question that
on
we
debt
have is related to
restructuring
the
as we
upcoming
speak.
shareholder meeting.
Debt restructuring
There's
coming
a
up.
question here. I would like to vote at that upcoming
Fantastic.
shareholder meeting, but how do I vote? I've not received any proxy information.
Well, I hope you all do vote, for those who own shares, that is. I hope you all do vote. In prior years, the voting numbers at AMC have been pretty low because it has been the habit of some retail investors not to vote. I would remind everybody this is a chance to have your voices be heard. We pay attention to what you say in these shareholder votes. We act accordingly. You know that I reduced my own compensation this year in response to what shareholders were saying in the so-called say on pay vote. So we really do want you to vote. We want to hear what you're thinking. But the way you vote is you go to your broker where your shares are held, and you get the proxy materials from your broker. If you haven't received proxy materials yet, I know that I've received mine as an AMC shareholder from several different brokers, but if you haven't received yours, you should call your broker. You should ask for your proxy materials. We do have a proxy advisor, a solicitor here in the United States called D.F. King. You can call D.F. King if you would like help. There's a toll-free number that's been set up, 1-800-859-8511. Let me repeat that, 1-800-859-8511. If you hold your shares through DRS, you get your proxy materials from the registrar, Computershare. And I just might add, since I know that we have many international shareholders who listen to these webcasts, we do know that voting in shareholder meetings for American companies is not as easy abroad as it is in the United States. And in some cases, it is impossible because some overseas brokerages do not facilitate getting proxy materials to shareholders. And we have discussed this at length. There is literally nothing that we can do as a single lister on the New York Stock Exchange to do anything about that. All we can do is suggest to you that you change brokers and change from a broker who will not get you proxy materials to a broker who will get you proxy materials. But as I said, we encourage you to vote. It's a good thing. And the shoulder meeting is coming not too far from now. With that, I think you're telling me we're done with questions? So we're going to thank you all for joining us today. I leave you with two simple thoughts. As we look at the box office for the end of this year and for next year and into 2026, the box office looks spectacular compared to what we've suffered with in 2020, 21, 22, and 23. And the second thing I leave you with is not too late. It's only 5 o'clock Central, 6 o'clock East. At 7 o'clock local time all across the country in our premium large formats is a special advanced screening of Kingdom of the Planet of the Apes. Should be a pretty big movie this weekend. With that, thank you all for joining us today.
That is solid.
Thank you. This concludes today's conference. You may now disconnect your lines at this time. Enjoy the rest of your day.
Kingdom, okay, the earnings report is over. Kingdom of the Planet of the Apes, early screening at AMC theaters at 7 p.m. Eastern time, I believe. This is beginning today. You still have time to support them, and you can be amongst the first to catch the flick. That is pretty great. And of course, if you're not an A-list member, you can watch up to 3 movies every week. And for the first month, it's only 99 cents. And then it's only a few bucks from there. It's really not expensive, in my opinion, considering what you get for it. This is great news overall. I really enjoyed that webcast. And so I will be voting yes to all of the things on the investor relations proxy summary, with one exception. There's one here that is requesting people to vote for DEI, diversity, equity, and inclusion bullshit. For that one, I will be voting no, but for the rest of them, I will be voting yes. I'll be voting for with my thousands of AMC shares. I will be voting yes for them. Let's take a quick look. Proposal 1. I'm going to read through them real quick. If you guys have questions, drop them in the chat right now if you have any questions, and I'm reading them now that it's over. That I don't have to worry about speaking over Adam or the board of directors. Any questions you guys have, go ahead and put it in. Luke says, need a new CEO. I couldn't disagree with you more. Adam Aaron is an absolute fucking silverback. He is the biggest shareholder of AMC Theaters. He has done an amazing job in increasing the revenues and profits and partnerships for AMC Theaters, AMC Entertainment, AMC Distribution. And the man is doing a fantastic job in spite of all sorts of different kinds of issues with the Actors Guild, the Writers Guilds, COVID, which forced AMC to shut down thousands of locations and take out loans in the billions of dollars worth. He's doing an amazing fucking job. The guy's got experience working for other companies in the past, and he's turned them around with great success, including Vail Resorts, who is now absolutely massive. And now he is doing a very good job in making AMC theaters profitable with the help of retail investors such as you and I. Jack says, if AA leaves, we're effed. If you know, you know. And that is why the hedge funds want him gone. Let's see. Proposal 1, amendment to our third amended and restated certificate of incorporation to declassify our board of directors, shorten all existing terms to expire at the annual meeting, and make certain other immaterial changes to the certificate of incorporation. This is standard business practices. Changes need to be made to the certificate of incorporations on a regular basis anytime there is changes to the company. And this is something I will definitely, as a business owner, as somebody who's helped build multiple multi-million-dollar companies, will absolutely be voting for yes for Proposal 1. Let's see. If Proposal 1A is approved to elect our board of directors the following nominees for terms expiring at the 2025 meeting. I will be voting yes for this because for each director nominee, because AMC needs the best board of directors that it can get. And businesses and the board of directors deserve to be compensated, especially as they're bringing a movie theater back to life that has now had 12 earnings beats in a row, 12 quarters in a row. That's 3 years in a row of earnings beats. And the price going down on the stock market is not something that Adam Aaron or this board of directors can go and change. They can't go up there and say, oh, well, you know what, I want the price to go up now, so it's going up. They're increasing the profitability, they're reducing expenses, they're paying down rents, and I think they're doing a fantastic job. And I did want to correct myself on one thing that I said. I did accidentally, falsely state that AMC had finished the issuance of shares. Now, I want to say that they can issue more shares up to $250 million worth. So far, they've finished about half of it and raised about $125 million worth, around 36 million shares. They can sell up to $250 million worth across the up to 80 million shares. So they're about halfway done with it. Regardless, AMC's price is looking much better than it did a few days and weeks ago. And I won't be surprised as soon as the share issuance is announced that it is completed. I won't be surprised that AMC's share price easily double. Again, this is not financial advice, but I believe that when they finish the share issuance, market makers and short hedge funds will cover some of their positions in order to bring the price back up. You see, market makers and shorts want AMC to issue as many shares as possible. It doesn't matter if it's 80 million total shares that they issue, because there are so many synthetic shares, so many operational shorts, naked shorts, synthetic shorts that have been created against AMC and GameStop and other stocks, etc., especially AMC. The short interest is over 20%. This does not include companies that are rehypothecating shares or that are located overseas, as they do not have to report their short interest. So, over the last decade, there have been tens of billions of synthetic shares, naked shorts, and operational shorts against AMC that has created a fake dilution of the stock and has helped to push down the price of the stock. In order to close out some of those positions, they need to buy as many shares as possible from AMC theaters. But even 80 million shares purchased from AMC theaters directly is insufficient in order to close out all those positions. It's like an ocean is overflowing and they're patching it up with a Band-Aid. They're only going to be able to patch up a tiny, tiny portion of that overflowing ocean. The rest of it will continue to flow. That is the MOAS. Proposal 2B. If Proposal 1 is not approved, to elect our Board of Directors the following nominees, terms expiring at the annual meeting. I already said I'm going to be voting for Proposal 2A. I will be voting for Proposal 2B. Proposal 3, amendment for our certificate of incorporation to eliminate the prohibition against stockholders acting by written consent. Let's take a look at that. To eliminate the prohibition against stockholders acting by written consent. I'll be voting for that. Proposal 4 is the amendment of our certificate of incorporation to remove the limitation on stockholders' ability to call special meetings. I'll be voting for that, to give stockholders the ability to call the special meetings. Proposal 5, amendment of the certificate to expand the exculpation provision to limit the liability of certain officers. Now, this does not mean that officers cannot be sued for wrongdoing. That's not what that means. It just protects them from frivolous lawsuits, which protects retail investors such as you and I who own the stock from losing more money to frivolous lawsuits that AMC would have to defend against, like they did in the past. And of course, AMC won those frivolous lawsuits. They just had to spend $100 million plus, which impacted their bottom line. Thus, I will be voting for Proposal 5, yes. And the ratification of the appointment of Ernst & Young as our independent registered public accounting firm for 2024. I'll be voting yes for that. The non-binding advisory vote to approve the compensation of named executive officers, say on pay, Proposal 7. Again, board of directors need to be paid. If they are not paid, they will have to be let go, and a shittier board of directors that is not interested in doing what these guys did, which was transfer in exchanging some of their cash for shares for future equity in the company. And so these guys gave up a large percentage of their cash that they were supposed to receive in the form of salary every year in order to receive shares of AMC. And if we get rid of them, even if they get a few more shares or whatever in compensation, then we'll have to pay more money in cash now to bring on a new board of directors, which they may not have the future of AMC, the best interests at hand, and therefore they may demand more money in cash up front, which could potentially lead to AMC being forced to issue more shares, or, God forbid, something worse. So, of course, I will be voting for their ability to approve the compensation of named executive officers, because AMC is a business, not a charity, and they still need to make some money for their efforts. Proposal 8, approval of our 2024 equity incentive plan. Proposal 9, adjournment of the annual meeting, if necessary to permit further solicitation of proxies. I'm not seeing here this diversity, equity, and other bullshit that we had talked about in the think tank. I'm not seeing that right now, but you know what? Why don't one of you guys post it up in the think tank for me, and I will go out and look at it right now. But again, board diversity, self-disclosure, just tells you what these people's races, ethnicities, genders, and other disclosures are. So I don't really see that as being a big deal. Good for them. Don't really care what color they are or what their background is, as long as they are actively working to do a good job. And that's what matters to me. So yeah, I'm not seeing anything about the DEI except for the self-disclosure, which really seems like a good idea to me. And as Adam Aaron has told us in the past, he has taken a 50% pay cut over the last 2 years in order to help retail investors. And not to mention, he's already getting paid in shares of the company instead of cash to help the company. So I think that's fantastic. They did beat, once again, revenue came in at $951.4 million versus the Wall Street consensus estimate of $861 million. So that was absolutely huge for them. So I'm really glad to see that. All right, ladies and gentlemen, let's see. Do we have any other questions? Yes. Okay, DEI is GME. So you guys can see my screen now. It's the infinity screen now of what I'm doing here with Streamlabs. This is how I multi-stream to X and to YouTube and such on multiple platforms at the same time. And yeah, DEI is number 4 on the GME vote. DEI is GME. So I will be voting no on the number 4 proposal that Axel Novian here is discussing in terms of the GME vote. Let me scoot that over in case you guys... Okay, it doesn't want to cooperate with me. But yeah, on the GME vote, that is not something that I'm interested in. Todd asks, did you hear if they messed with the CAT system yesterday? Now, you see, guys, they did talk about the CAT system quite a bit here. Let me switch this up for you guys so you can see. Which one should we... Okay, I was muted. Thank you, guys. Thank you very much for that. Good looking out. David, Thelios, Ken. David, I got you guys. I was muted. That one screen did not have the Blue Yeti mic active, which is ridiculous. But anyways, we've got it up here. The Securities Exchange Commission is currently sitting in front of Congress and the House Financial Services Committee. They are trying, the House Financial Services Committee is trying to get to work for their hedge fund buddies. They are receiving a lot of money from market makers like Virtue Financial and from Citadel Securities and Jane Street and so on. Stella said it correctly. She said, I read his lips and he said, hedgies are fucked and we're going to be rich. Well, ladies and gentlemen, this is not financial advice, but hedgies are fucked and we are going to be filthy fucking rich. At the end of the day, shorts haven't fucking covered. Market makers are still creating rehypothecations, naked shorts, synthetic shorts. Diaz, you silly fucker. Now, Congress is receiving lots of money from market makers to get them to disapprove of the consolidated audit trail system. And to put it simply, that means that they're scared shitless of the consolidated audit trail system. They're terrified. And everything that they do is for the purposes of making retail believe that the CAT system is an overreach of their regulations, and they're trying to scare people into make them believe that your privacy is at risk. Well, I've got a little news for you, ladies and gentlemen. Your privacy is already at risk because market makers like Virtue Financial, like Virtue, whatever the hell the other part of their name is, allegedly, according to the SEC lawsuit that was recently issued, are giving your personal and private information, including your order sizes, amounts, timestamps, and everything else you can think of, to their hedge fund. So the market maker, Virtue, is using payment for order flow to buy your orders from the brokerages, processing them in dark pools, and sharing that information with their hedge fund so that they can look you up, John Smith from 123 Street Drive, and see exactly how many shares you decided to purchase or sell, options, etc., what price you purchased them at what time, so that they can try to front-run your trades or process your order in a dark pool to distort active price discovery, to suppress prices on your favorite equities, and to make money ahead of you. That is the real crime. That is the real issue here. And they are protecting their hedge fund and market maker buddies and conglomerates instead of thinking about the average American family. So we have had multiple situations where I've had to actually ratio some of these bastards in Congress with the help of retail investors such as yourself, in which Representative French Hill in September of 2023 was trying to claim that the consolidated audit trail is an invasion of privacy. And as I said here, of course he received 33,000 views and only 138 likes. The consolidated audit trail is highly needed and wanted by retail investors, period. Market makers and short hedge funds should have to report all of their short positions. Allowing market makers to illegally abuse 203(b)(I) short reporting regulations, short reporting exemptions is disgusting. It is ridiculous. It is a travesty. And they are stealing from everyday people, both Americans, Europeans, Asians, and those around the world. This is happening every single minute of every single day, in which they can create 203(b) short exemptions in order to naked short a stock and create synthetic shorts and synthetic shares, even if SSR is on, even if the stock is on the Reg Show threshold securities list, even if it's hard to borrow, even if there's no shares. This is why they call Doug Sifu and Ken Griffin the liquidity fairies. One, they're fucking fairies. Two, they go out and get liquidity out of thin air. They say, oh, you're buying on Robinhood? Here, I'll buy that order. I'll front run your trades. I'll process it in a dark pool. That's the beauty of payment for order flow created by the world's biggest crook, Bernie Madoff, in the 90s. And then, of course, as the chair of the NASDAQ, he implemented it, and it has been par for the course ever since. Of course, people out there think Robinhood and Webull and all these other companies are giving you free trades. Well, as of course, you may or may not know this, but when anything is free, what's the saying? You are the product. Your information, your trades, etc. is all being front run, and you are paying more in hidden commission fees than as if you were actually just paying $3, $4, $5 a trade. Oh, but I'm only paying fractions of a penny. Maybe so. But if that was the case, why would Robinhood have to pay $65 million to the Securities Exchange Commission for costing retail investors over $34.1 million more than if they had just paid a commission? Because payment for order flow does not save you money. It just makes it so that you can't fucking see. You're like this when it comes to the costs as to what you're actually paying for. And Virtue Financial is being sued by the Securities Exchange Commission for, of course, receiving your private information from their market maker subsidiary in order to illegally front run your trades. And of course, we demand that Congress and the House Financial Services Committee approve and pass the CAT system. And we have been doing that. And of course, with a measly 6,600 views on this, we ratioed this asshole by over 300% in the reposts, 146 to 52, and over 300% in likes, 385 compared to his 138. Of course, nobody actually agrees with Congress in what they're doing. They are just struggling to be able to do much about it. So yesterday and today, they were discussing the Securities Exchange Commission in crypto. They were discussing the consolidated audit trail. And we need this trail of breadcrumbs. We absolutely need it because this will allow the Securities Exchange Commission to go out and track naked shorts. They'll be able to track rehypothecations, track failures to deliver, track short sales. You name it, legal or illegal, it will be able to track everything because their thumbprint, their fingerprint will be on every single share. And we need that because look, M1 Finance, a brokerage, a European broker-dealer, was just fined only a measly $400,000 by FINRA for cooking the books and mismarking over 12 million short sales as long. This just yesterday. These are liabilities that have infinite risk, ladies and gentlemen, that they marked as assets. That means they're literally taking something that has infinite risk to bankrupt all of them and their prime brokers that they're lending money from, like Archegos did with Credit Suisse, and they're marking them as an asset. That's the very definition of cooking the books. Again, I've said this before, I'll say it again. If any one of us did this, we'd go to federal prison for the rest of our fucking lives. But these guys, they pay $400,000 in fines, and they did this from 2016 through today. M1 Finance agreed to pay a fine of $400K as part of a settlement with FINRA. Of course, the slap on the wrist because FINRA, well, look at who sits on the board of FINRA. It's a lot of these same players. From March 2016 through the present, M1 Finance violated Reg Show Rule 203B, the market maker exemption, and Rule 200G, and FINRA Rule 2010 by affecting more than 12 million short sales without locating securities available for borrowing. That means naked shorts. That means selling shares of stock that you don't own and never buying it back. 12 million short sales. God knows how many actual how many actual shares were involved, because those are just the number of sales. And they inaccurately marked those orders as long by inaccurately recording these short sales on top of another 3.5 million principal buy orders as they executed that in an agent capacity for their retail investor clients. They maintained inaccurate books, aka they cooked the books, and they violated the Exchange Act sections, etc., 17A, 17A3, FINRA Rules 4511, blah, blah, blah. If I name them all, I'll never finish. But you can see this is something that they've been doing from 2016 through today. And of course, they don't have to reverse their positions. They get a slap on the wrist. We asked yesterday, I posted this poll, and it said, do you think they should keep their brokerage license? This is a broker-dealer which retail investors like you and I are buying and selling shares on. Should they keep their brokerage license to trade on behalf of their clients? 2.2% of 1,823 voters said yes. Let them cook the books. Less than 1% voted maybe. 10% voted to take away their license as a broker-dealer. And 87.1% of the 1,823 voters in one day, there are still 2 days left on this poll, voted for jail time and delicensing for M1 Finance for cooking the books, mismarking short sales as long, liabilities with infinite risk marked as assets. That is an absolute fucking travesty. Wolfie, have a great night to my European apes. I know it's getting late over there. It's probably around between 11 and midnight in most of the places in Europe. We're going to wrap this up here in about 6 or 7 minutes. Ross, I'm going to answer a couple more questions. Ross Trundle asks, when is the final decision? We will know by today. And just so you know, guys, I'm pretty sure, I believe that to stay on the topic, or to go back to the topic, let's revert here for a moment. I do believe that the Financial Services Committee and Congress will disapprove of the cryptocurrency oversights by the Securities Exchange Commission. Now, I also believe that if we get lucky, they may overlook the ruling on the consolidated audit trail. Now, let me look it up right now. House Financial, to see if there was any changes, because they did hearings on this yesterday and today. Let me look at their memorandum and schedule for yesterday and today, because I was watching some of it, but I didn't watch it for the entire day. We are looking at May 7th and May 8th. But it was mostly yesterday, and this was, as you can see here, the hearing entitled Balancing Deterrence with Due Process. Here's a live stream of the hearing. This is legislation that they tried to enact, but only this one actually has an HR number of 6695, the Due Process Restoration Act of 2023. To authorize private parties to compel the SEC to seek sanctions by filing civil actions and for other purposes. The ones in which they're trying to disapprove of reporting of securities loans, which of course, why wouldn't you want reporting of securities loans unless you're getting money from the assholes that are cooking the books, that are marking shorts as long, that are creating rehypothecations? Of course, that's something we would want. They also were trying to disapprove of short position and short activity reporting by hedge funds and institutions. Of course, they were trying to disapprove of the definition of dealers and government securities dealers in connection with certain liquidity providers. They were trying to disapprove of reporting requirements for all filers and large hedge fund advisors. Why? Because these assholes get money from places like the Mercatus Center. And Hester Pierce, who works for the Securities Exchange Commission, was previously a senior research fellow at the Mercatus Center from 2012 to 2018. And she received 98% of her salary from the Mercatus Center. As you can see here, the nominee to oversee Wall Street works at think tank dedicated to blocking regulation. Hester Pierce allegedly received 98% of her salary directly from the Mercatus Center. These are probably not allegations, considering I'm sure they have paperwork on this. A think tank that provides an academic facade to a radical anti-regulatory agenda. That means that they are hedge fund babies. Okay, so the Koch Industries, K-O-C-H, not Coca-Cola, K-O-C-H, and the Rothschilds are the heads of this administration. And you can see that's Hester Pierce, who is anti-regulation, anti-market reform, anti-cryptocurrency reform, anti-short reform, anti-retail investor. Has consistently voted against transparency in short reporting. So that being said, you can see here Hester voted no for hedge fund transparency. She's fully paid and sponsored by the Mercatus Center. She received 98% of her salary from the Mercatus Center. And the Mercatus Center executive director is Daniel M. Rothschild. Have I said enough? I think I've said enough. And the rest of the board is the Koch family, etc., and other people that want to destroy the 99%. So I'm hopeful that it did not pass, but I will look into it even further.
And protect market integrity. And time and again, if you look at all these decisions, and I've read every single one of them, you're talking about almost 200 SEC cases that are crypto related. And you have the LBRY case, the Kik case, the Terraform Labs case, where judges have really gone out of their way to present exhaustive analyses about why these tokens, or whatever you call them, why this mathematical formula of digital asset is a security. And I think it's pretty obvious to these judges and pretty obvious to most securities lawyers as well.
I do like to see guys like John Reed Stark talking about this. This is good to see. So some people are fighting for short transparency, short reporting, short reform, and that's what we're doing as well. You may or may not know this, but I'll finish with this. We're creating a new broker-dealer, a stock brokerage firm that allows retail investors to trade directly on lit markets without having to worry about manually routing every order, without having to worry about price distorting dark pools being used from payment for order flow for hedge funds to front run your trades. And without having to wonder, how much am I actually paying in commissions? Because as we stated here, payment for order flow is legalized front running, period. Even says Dario CPX, piggybacking off the tweet that we put against Robinhood, in which the SEC has ordered that Robinhood pay retail investors $65 million. The order found that Robinhood provided inferior trade prices that in aggregate, that means total, deprived customers of over $34 million, even after taking into account the savings from not paying a commission, because it's all rolled into the fucking share price. You're paying more through Robinhood than if you were just paying $3, $4, $5 a fucking trade. And not to mention, they're lying to you about it. They're making money hand over fist. You think you're getting a good deal. They're stealing your information, and then Virtue Financial, the hedge fund, can get the information using payment for order flow and dark pools to distort your prices and front run your trades. Period. That is what Congress was trying to claim that the Securities Exchange Commission would do. But of course, that doesn't make any fucking sense. It says anybody who understands the actual markets. And I can tell you that Congress does not understand markets beyond the fact that they receive insider information and act upon it. So, Stella, thank you very much. Have a great night. Have a great day. I wish you all peace and wealth. Topaz Yates, if the AMC board is voted out, I will probably sell my position. I will not sell if the chief executive officer, Adam Aaron, remains. I will not sell if the rest of the board remains. But if retail investors are stupid enough to vote out the board of directors of AMC, even though I've been in the stock for over 3 years, I'll probably sell my position. And I own hundreds of thousands of dollars worth of AMC. I own thousands and thousands of shares, call contracts, you name it. But if retail is really that stupid, like in 2021, people were too stupid to, and I'm sorry if you voted against this, but retail should have, as even I was saying, that retail should vote for allowing AMC to issue new shares because they had to pay debt. A lot of people listen to YouTubers and influencers that don't know their ass from a hole in the ground when it comes to business. And AMC wasn't allowed back then to issue shares. If they had, the squeeze in January and June of 2021 would have continued, possibly achieving MOAS and saving the company and preventing more further share dilution. But people voted against it because they thought, oh no, share dilution is bad. And what ends up happening is companies could potentially go bankrupt, and then instead of losing some percentage of your money and then having a percentage to get that back 10 times over or 100 times over through the run-up in share prices, people were convinced into voting no. And that was a big problem. People were convinced into stopping buying call contracts on AMC and GameStop, and that was a big problem because without call contracts, there is no gamma on the shares. Market makers are buying up call contracts on AMC and GameStop, and they're using them as synthetic long positions in order to marry them against other calls and puts, thus preventing them from having to properly hedge so that they don't have to buy shares. So they're just buying call contracts and marrying them with others other shares and other contracts in order to prevent the stock prices from going up, aside from spoofing and rehypothecating. And as long as retail doesn't step up the call buying and the share buying, that will continue. But again, just like in the video from Charles Gradante, the hedge fund manager that I was showing you guys shared earlier, AMC and GameStop absolutely need the buying of both shares and call contracts, because all of the open interest that is on AMC and GameStop does not exist solely for retail investors. A lot of that belongs to, drum roll please, market makers, shorts, institutions, banks, prime brokerages, broker-dealers that are, you guessed it, creating synthetic longs by marrying calls and puts with other shares to prevent themselves from having to hedge. But sufficient gamma pressure by call contracts being near the money or at the money or in the money will create delta hedging from market makers. Delta hedging means hedging for cash, hedging for money, for dollars, making sure that they're properly hedged. They're buying up shares of stock, and that forces the price to go higher, shorts to have to short it further or to close or cover some of their positions. As a lot of you may know, this is far from over. I truly believe there are billions, actually tens of billions of synthetic shares, rehypothecations, operational shorts, naked shorts, failures to deliver on AMC stock. And it ain't over till it's over. It ain't over till the fat lady sings. AMC has had 12 earnings beat quarters in a row. 12 beats in a row. That's 3 straight years. And they have over $500 million in cash on hand. This company ain't going fucking nowhere. And neither am I. Because I'm not fucking selling until these assholes that are shorting the company receive their comeuppance. I'm not leaving. Jane Street, State Street Bank, Virtue, Citadel, and all of their other friends, Melvin Capital, Tiger Capital, and dozens of others that are already bankrupt and insolvent just like them, were just a taste of what's to come. I wish you peace and wealth, motherfuckers. Have a great day. I mean, I say that with love, of course. Thanks, ladies and gentlemen. I'm not worried about another reverse stock split. There's no reason for another stock split. There's no reason for another reverse stock split, I should say. The purposes of that, it doesn't make any sense. They don't need to do that. There's no reason for it, and they won't do it, in my opinion. Again, that's not financial advice, but that would be like saying we have all $625 billion in cash on hand. Let's do something that we have no reason to do. It just makes no sense, you know? It's like if you just got your oil changed last week and you've only put 100 miles on it, are you going to go get your oil changed again next week for no reason? Like, why are you going to spend the money to do something like that just to waste your fucking time? Like, I'll be honest with you, like, don't believe everything you hear on the internet. Appreciate you sharing. Andrew, Giles, thank you very much. Ken's, Diaz, Brandon, ladies and gentlemen, thank you very much for your support. I really appreciate